Hey, I'd like to introduce someone whose voice you've heard on the show before, and that is Chad. And we have a fantastic little YouTube raffle for you. Chad, what's it all about?
Yes, we have an exciting opportunity coming up for you to be able to win a free ticket to meet the Masters coming up in March, or a $500 travel allowance. Here's what you need to do to be able to win one of those things. We will be selecting a winner on March 4th when the contest ends. And all you have to do is go to the YouTube channel, which is youtube.com/Jason Hartman Real Estate. Subscribe if you haven't already. Then pick any video to watch. There's a variety of categories, everything about real estate investing, from finding the right markets, analyzing real estate deals, the economics of real estate investing, property management, financing. There's a whole wide range of videos that you can choose from, and choose one that you think would be interesting to you, watch it, and then go to the comments section and comment just a quick one-sentence comment on something that you learned from that video. And make sure to include the hashtag JHLive in the comment, and that will enter you into this raffle.
Okay, so that's real easy. You just go to youtube.com/Jason Hartman Real Estate, subscribe to the channel, and then watch any video you like, and make a comment below the video of one thing you learned, include the hashtag JHLive, and that will enter you in the raffle to win a free ticket to meet the Masters or a $500 travel allowance. This ends on March 4th, so be sure to get it done before March 4th. We look forward to seeing you at Meet the Masters. Thanks for joining us, Chad.
Thanks.
This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
It's my pleasure to welcome a returning guest back to the show. He's an old friend. He's been on many times, and that is charter financial analyst and author of several books on economics and finance, Mr. Dan Amerman. Dan, welcome. How are you?
Good, Jason. Thanks for having me back.
Good to have you on again. So my listeners have been following your work over the years as we've had you on the show. I think I've been following your work for a good 12 years now, I want to say. Would that be about right, since I went to that first event?
That sounds about right.
Yeah.
I remember I met you in Newport Beach in 2008.
Yep. Then it is about right. Yeah, exactly. What is going on now? You've been lately diving into studying the Fed cycle. I'll have you explain to the listeners what that is, but what it means to real estate investors in general, the broader economy. Tell us what your latest work involves.
This is something I've been doing for a number of different years. And what I've done recently is I've taken a much more heavily quantitative look, and I've also created a framework for looking at what's been happening in terms of the Federal Reserve interventions. They've been getting much more heavy-handed than they used to be. We are now seeing some flashing warning signs of a possible recession next year or two. We don't know for sure yet, but it looks like the chances have really been rising. And that means that we could be seeing some truly major Federal Reserve interventions again. It looks like the Federal Reserve has effectively paused when it comes to its increasing interest rate cycle. And it looks like the Federal Reserve is also effectively about to pause its winding down of the balance sheet, which means the starting point for any future expansions, instead of being under $1 trillion, may be $4 trillion, and then building on top of that. Something else that I've been studying that I think would be of particular interest to your readers, and I put together a series to kind of make it visually obvious so people can really understand that I'm calling the 5 Graphs series, which is taking a look at real estate prices, how they used to behave, and how they are now working in a just entirely different way than they used to, and how to understand what's happening with the economic cycle, with the traditional Fed cycle, and then we have this amplified Fed cycle where they're just basically doing more and more major interventions all the time. And that is very directly spilling over into changes in real estate prices on a national basis.
Well, that, you had me at real estate prices, Dan, and I think you had everybody else. So you're saying that the traditional influences of those cycles of real estate prices up and down are different now? Are we in a new era?
Yes, we are. And we have been so since about the year 2000.
Okay.
And the change was just radical. And again, I have this is a series of graphs, so there's a visual component.
Right.
It's a lot easier to just look at the visual side instead of talking about it, but I'll try to talk you through it.
Right.
If you go back in terms of real estate data in history, it's much more problematic than things like stocks and bonds and so forth, because the issue is, of course, the country has been changing the entire time, and that's reflected in real estate prices. The average size of the home has been increasing over the decades. The average amenities have been increasing. And we've also had an increasing concentration of the population into higher dollar urban areas instead of the more lower dollar small town rural areas and so forth. So just literally tracking housing prices doesn't really do anything for you. One thing that people do, of course, is they track the Case-Shiller index. I very much prefer to use the Freddie Mac housing price index, but what each of those have in common is that they use a pairs-based methodology. So they're taking basically the same homes and they're tracking the sales prices on them at different points in time instead of just average homes. So you have a really good idea that if you're comparing prices from 20 years apart, and of course there's all kinds of averaging and so forth that goes on,
right.
It might be this 2,200 square foot house on this block in this neighborhood.
Right.
How much does that price change?
Yeah, let me say a couple things about that. So number one, I like this methodology because, it kind of reminds me in the world of the stock market when they're looking at retailers and they talk about same store sales, right? Because that's sort of like if a company is expanding and it has more stores, or it's contracting and it has fewer stores, and more, businesses condensed into those fewer stores, or the expansions just because it's, got all this new market share, that doesn't really tell you as much as same store sales, right?
Yes, and it's same house sales is very much the same thing. It's a much more accurate way of tracking things.
Right. The only thing we have to look at on that is that, I don't know, most or many or what the right word is, but a lot of times these houses are improved. Sometimes they're improved pretty dramatically if it's one of these sort of investor areas where there's a lot of rehabbing going on, or one of these yuppie areas where there's a lot of keeping up with the Joneses going on, right? Either one of those will be what I'll call high improvement, like that's added value. That's not appreciation. That's just improvement, right? And there's a difference.
Right. Mm-hmm.
So it doesn't account for that, but it's still better than the other way.
It is. The issue we have, though, is you can't really go back to, say, 1910, 1920, 1940. It wasn't really being gathered then. So effectively, we're going back to the early to mid-1970s. Mm-hmm. The initial period that I tracked was 1975 to 2000, and it was fascinating because homes were an almost perfect inflation hedge during that time period. In fact, they were a much better inflation hedge in terms of correlation with changes in dollar value than gold is. A lot of people say that couldn't be true. Well, it's absolutely true. Yeah. Housing would move up and down in a range, and I looked at it on an inflation-adjusted basis very consistently within 10% of the long-term average. It would basically never go below that or never go above that. So if you use a principle some people use called regression to the mean, which says whenever you get too far away from average, that investment's going to move back the other direction, that worked perfectly for housing for many years.
Right.
But then we had the crisis of 2001, which followed the popping of the tech stock bubble. And we had a recession at that time. And that's when the Federal Reserve really kind of got the crazies going in terms of the interventions and the amplifications we've seen since then. In order to contain the damage from that recession and to try to reboot the economy, they moved interest rates down to a 50-year low, which was below 1%.
Right. And in real terms, I think we'd probably both agree those were definitely negative interest rates, right?
Yes, absolutely. Yeah. The other thing that happened is they moved mortgage rates down to 50-year lows. If you track it graphically, it's just like a perfect correlation. You can see exactly where the real estate market, single-family housing in the United States, just completely burst out of its previous bounds. And it went up by almost 6 times what it previously would have been in terms of a maximum. And so instead of going up by 10% in inflation-adjusted terms on a national basis, and that's the nice thing about the Freddie Mac index, Case-Shiller is just the 20 largest urban areas. Freddie Mac is all 50 states. Just even going across all the different rural areas, including all of that, it was still about a 60% gain. And then, of course, it came back down again. But the interesting part is it never returned to average. It never came down to the mean. And since then, it has, of course, rebounded since about 2011, 2012. And in nominal dollars, we have the highest prices yet. In inflation-adjusted dollars, and again, you have to see the graphs, it's an almost perfect duplicate of what we're seeing in the early 2000s, if you look at current real estate prices. And in order to explain that, I then took several other factors into account. The first one was changes in the yield curve. And you may have been talking about changes in the yield curve recently. A lot of people have been doing so in terms of a potential yield curve inversion. And typically what happens is that yield curve changes are kind of contracyclical when it comes to the overall interest rate cycle. Generally, when interest rates are going down, yield curve spreads are increasing. So that means that mortgage rates are not dropping as fast as, let's say, short-term rates. But on the other hand, when rates are going up, as we were seeing until very recently, short-term rates tend to rise much faster than long-term rates. And because just 30-year fixed-rate mortgages is the most common example there, that's priced above the 10-year Treasury. So that the yield curve spread helps explain how that goes up and down. And if you put what the Fed is doing together with, and again, this all works better graphically, with the changes in the yield curve, you get changes in mortgage rates. Then you get changes in mortgage payments when you, on an inflation-adjusted basis, when you build in the prices as well. And once you take those 5 steps and you put them all together, you have a perfectly predictable pattern where housing prices begin to make perfect sense.
Right. Yeah.
And where we currently are and where we were in the early 2000s were entirely logical when you look at mortgage payments on an inflation-adjusted basis.
Okay, that's good. And so let's remember that, and let's go back to that in a moment. But the thing we also, of course, have to say, which I know you understand all too well, but just to remind our listeners, and we may have some new ones, 3 types of markets: linear, cyclical, and hybrid. Most of the attention goes to those cyclical markets with a glorious highs and the ugly lows, not the, middle America linear markets that we like the best. And all of this talk about pricing doesn't take into account rental rates. In fact, like you mentioned earlier, Dan, a lot of that is counter-cyclical because when, prices decline or soften at least, and there's not as much interest and urgency to go into the for sale market, we usually see upward pressure on rents. And then we see the opposite when the sale market is just going crazy. This is the problem with having a Federal Reserve. It reacts too quickly. If the marketplace was governed by a free market rather than a centrally managed economy, we would see, I would argue, much more gradual changes in ups and down cycles. But when the Fed cuts interest rates, or they raise them and cause urgency by raising them, to a point, obviously, then it levels off or declines. But, it just causes too much craziness in the marketplace. It's like a feeding frenzy. It's ridiculous. That's not a normal market shift. It's the result of a centrally managed economy, right?
And it's now directly translating into real estate prices to an extent that is historically unprecedented. Or I should say the last approximately 20 years have created an entirely different price cycle. And as you point out, of course, that's different in different regional locations.
Yeah. Okay. What does this mean today and what can we expect? Well, predictions, everybody, everybody wants a prediction yet. Few are willing to make them, but what do you think?
Oh, I'm willing to make one.
Okay.
And this goes back to analyses I've been doing for many years, but I have a current series going where I'm looking at how the Fed has reacted at different points, changes in the cycle over the last 20 years and what it does next. And we have unless they've repealed the business cycle, we're going to have another recession.
Right.
And I did a recent piece tracking this, looking at the characteristics at different points in time. We've had 34 cycles of recession and expansion over the last 164 years. Mm-hmm. The National Bureau of Economic Research looks back to December of 1854.
Wow.
And it's kind of a night and day cycle. Mm-hmm. And every time you get a really long day going, there's a group of people who will decide, well, that nighttime's not going to happen again. This time is different. It's those famous words that always get you in trouble. This time is different, and then it's not. But what is truly different is that we have an increasing number of warning signals of a potential recession starting in the next 1 to 2 years. Mm-hmm. And the Fed this time around had to pause their increasing interest rate cycle at the lowest levels that we have seen in many decades. Mm-hmm. They're only about between 2.25% and 2.5%. Mm-hmm. And here's something that we know about the Fed. We know what their policy is. We know, and again, I've got graphs of this and more information on my website. Mm-hmm. Modern monetary policy, which sounds really complicated.
Yeah, MMT. We've had some interesting discussions about that on the show.
This isn't actually MMT.
Okay.
This is just monetary policy.
Oh, okay. You're not talking about the philosophy known as MMT.
No, I'm not talking about that.
Okay.
I'll bet you had some interesting discussions.
Yeah, we had Mike Norman on. He hung up on me, but then he came back on and did the show and complained the next day. It was kind of funny. It's entertaining.
What the Fed does, and they do it every single time, mm-hmm. and it's not that complicated, is every time they're either in a recession, they may have not realized it because this doesn't, don't have the statistics in real time, or they think they're about to go into a recession, they take a sledgehammer to interest rates. Mm-hmm. Yeah. And they knock them down.
It's too sudden. It's too abrupt. Yeah.
Exactly. And we know exactly what they're going to do, and they're talking about it in the minutes. If you look at some of the FOMC meetings, the first thing they're going to do the next time they think we're in a recession or we're in danger of going into one is they're going to immediately reduce interest rates to zero. Mm-hmm. They're going right back to it.
Yeah.
And if you look at their staff discussion, this is publicly available, again, minutes of the FOMC, what they are expecting is that rates at what they call the ELB, the effective lower boundary, which is 0%, that's just Fed speak, to be more frequent and more protracted in the future than they've been in the past. Mm-hmm. So as far as the Federal Reserve is concerned, I think a lot of people think that our 0% interest rates were just kind of this one-time anomaly that couldn't be predicted and will never happen again. Mm-hmm. Now, the Fed's expecting we'll go right back there. Mm-hmm. We'll go back there frequently, and we'll go back there for longer periods of time than we've been in the past. Mm. And that completely changes things when it comes to real estate.
It sure does.
Values.
Yeah. Dan, here's the million-dollar question. And, we've seen this kind of reloading behavior of the Fed, reloading the bullets into the gun for the next cycle, right? We've seen that lately.
But they got cut off. They couldn't do it.
That's exactly what my question was. Do they have enough ammunition to, and maybe we should just explain this concept to the listeners a little bit. Not everybody, I'm sure, thinks of it. But the tools the Federal Reserve has, when the economy gets tough, it's usually because the money supply is constricted, right? So they can increase the money supply. They can do it through, reserve rates with the banks. They can do it through just pure printing of money or, electronic money creation. They've got some tools like this, right? And so by keeping interest rates too low, then they don't have any tools. They don't have any ammunition if things get bad during a low rate environment. And, look at Japan, right? That's an interesting study. So they've been trying to raise the rates and take the punch bowl away so that they have some ammunition ready for the next cycle, which makes us all think maybe they know the cycle is coming, right?
Oh, they do very much, and they are talking about it. Sure. They have their staff presentations at the Federal Open Market Committee. I cover this graphically, of course, as well as the actual numbers in a recent analysis from within the last couple weeks that I put out called "Will the 35th Recession Bring a Swift Return to 0% Interest Rates?" And just to hit it real quickly here, if we go back for the last 5 recessions, the last 5 Federal Reserve responses in about the last 40 years or so. In the recession of 1980, the Federal Reserve dropped interest rates by about 8.5% in 3 months.
Wow.
Now, you want to talk about an active intervention? There's an active intervention.
Yeah.
The 1981 recession, they dropped rates by 10.5%. The 1990 recession, they dropped rates by a little less than 7%. 2001 recession was about 5.5%. So if you look at the averages of those 4 episodes, each of which were actually shorter recessions than our average on a long-term historical basis, they're dropping interest rates by over 7%. Mm-hmm. And then the problem they ran into, and this is all interconnected, real estate values, the economy, and so forth, is that they were trying to increase interest rates when they saw developing economic problems in 2006. Mm-hmm. So they got worried and they paused. All right. And the yield curve inverted, by the way.
Right.
This is really interesting. Financial crisis of 2008. In 2006, we had something very similar today. The Federal Reserve paused and there was a yield curve inversion. In the year 2000, the Federal Reserve paused. There's a yield curve inversion. Mm-hmm. 2001 recession followed. In the year 1989, the Fed paused. There's a yield curve inversion. The 1990 recession followed. But the problem this time around is because they had to pause before they had the ammunition enough to really knock them down. Mm-hmm. Knocking interest rates down to 0% was not enough. Mm-hmm. It wasn't nearly enough. And that's why they had to go to all the quantitative easing and balance sheet expansion craziness, was because they didn't have the room. Mm-hmm. Now, if you look at where we are today, we're less than half that high. If you look back over the last 40 years, what it takes to get out of recession just by slamming interest rates down, that's what monetary policy really is, or at least the most important component. You slam interest rates down, we're only about a third of where we need to be. Mm-hmm. So what does that tell us? Well, it tells us 2 things. First, as almost as certain as the sun coming up in the sky, if we run into another recession, those interest rates in terms of Fed fund rates are going straight down to 0%. And then where things get interesting is how they make up for the lack of ammunition, what else they do beyond that. And you certainly have some possibilities. I think the Fed is most interested in balance sheet expansion, which is just a Fed speak way of saying incredible monetary creation on a scale we've never seen before. Another possibility would be literal negative interest rates in the United States. Mm-hmm. Another possibility, and this is what the OECD is pushing. I did an analysis on this back in December, and this didn't get nearly enough attention. The OECD, one of the major international organizations, called to the developed nations of the world to work together to develop a plan for coordinated massive deficit spending in the event of another recession.
Wow. So Keynes has taken over the world, huh?
Indeed. Now, each one of these things probably individually sounds crazy to the average person, even though we've seen variants of all 3 of these all over the place over the last few years. First, 0% interest rates is tough enough. Extraordinary new round of monetary creation is hard to believe. Literal negative interest rates in the United States are hard to believe. Quickly tacking on another $10 trillion on the national debt, let's say, on top of everything else is hard to believe. But those are kind of the choices.
Yeah, wow. That's
because they simply don't have the tools they believe they need. And again, we don't know what would happen if the Fed were to just disengage and not do that at all. Right. But the problem is they've got the power, and we know they have no intention of disengaging. Mm-hmm. Yeah. So whether they're right or whether they're wrong, this is what they're likely to be doing to us. And this is going to set off very rapid investment price changes across numerous different categories. And in my opinion, we have to believe that investment real estate is very much going to be one of those categories.
Mm-hmm. So we'll see asset inflation in investment real estate. And tell us about general inflation. That's what that means, right? I mean, it seems obvious enough, but, sometimes it's a little more nuanced than that.
It can be quite a bit more nuanced than that. There's really 2 different ways of looking at inflation. And there is kind of the general public version, and then there's the financial mathematics version. In terms of the general public, it's very easy to leap to, this is all craziness. Wile E. Coyote just ran off the side of a cliff. None of this makes any sense. Certainly, we're going to have immediate hyperinflation or something like that. And that could happen. Monetary collapse does happen. And that's happened a number of different times in history. But there's other ways of holding things together. And one of the best ways of doing so from the perspective not of you and I, not of the citizen or the investor, but from a governmental perspective, is to have controlled inflation and use that to essentially wipe out the debts as well as saver assets as well as investment assets in a manner where most people or most voters don't truly understand what's going on. And in that case, what you need is a real rate of inflation that is somewhat higher than what is being publicly stated. For instance, we could say that if we go to 0% interest rates and the government says we have 2% rate of inflation, but in fact, if you look at the average prices that everyone is paying for everything, and I think we're each in positions, Jason, where we talk to a lot of people and we know prices are going up higher than what the government says they are on a national basis, then maybe we've got a 4% real rate of inflation. And if that means we have negative 4% interest rates, the government can do amazing things with that in terms of maintaining financial stability, but the costs are extraordinarily high for most people who are doing what they're supposed to be doing, so to speak.
And doing what they're supposed to be doing is the old version of saving money and that kind of old-fashioned style, which should make sense, right? If we lived in a normal world where they weren't debasing our currency all the time, right? Is that what you mean?
Yes.
Yeah. Something, it's really mind-boggling, it is. But it creates, Dan, as you have so aptly pointed out for so many years, tremendous opportunities for those people who, I don't want to say game the system, they just simply do what the powers that be do. They inflate away their own debt.
It's about understanding what's going on and what financially benefits, not the average person, we'll call it the government and the insiders and so forth, and finding ways of accessing that. And as you know, and this is where we first met each other all these years ago, I do believe that using asset liability management principles with income properties is a particularly good method for doing so. It's not the only method, but it's a good method for doing so.
Yeah. It's not the only one, but it's the only one that has the self-liquidating debt attached to it that I'm aware of. I mean, you could do it with a business, right? But there's a lot more moving parts. You can't do it with precious metals. You can't do it with cryptocurrencies. I never got into the cryptocurrency fad. Sadly, I think it is a fad, but I'd like to be wrong about that. I've stated that many times. but what else can you do it with?
There's different ways of doing it. The nice part about investment real estate, cash flow real estate, with a moderate amount of leverage in terms of trying to create a safe asset liability management position, is that on the one hand, owning homes is far more active than, let's say, passively buying stocks or something like that. But on the other hand, the fundamental wealth transfer mechanism is more or less passive in that case, as you say, with the self-liquidating liability, where the interest payments are not increasing with inflation, even while the value of the home and the rents that are coming in are more or less increasing with inflation. The other alternatives, and this is part of the reason for my work, why my work has gone down some very different paths than it was, say, 10 years ago or so, is I've been getting a lot of requests from different people who are saying, okay, properties are great, but I've got these assets in my retirement account, and I want to be able to know what I can do with those to protect myself from this situation, or maybe even come out somewhat ahead. And there are alternative ways of doing that as well, but we got to raise our game a little bit and have a better understanding of what the Federal Reserve is doing and how that impacts each different investment category. So what I currently use is I have a framework where I have the columns are the changes in the Federal Reserve cycles, the economic cycles and so forth in these amplified times. And the rows are the investment categories. And row 4 in this case happens to be real estate. So if you look at real estate in a crisis, that would be cell A4, column A in row 4. If you looked at real estate in the containment of crisis, that would be cell B4. which is, containment of crisis in real estate.
Yeah, that's really good, Dan. Thank you for sharing that. The one thing I do want to say, if some listeners didn't catch it, the concept of the self-liquidating debt is that the tenant pays your debt for you. You outsource your debt obligation to the tenant. And also, as Dan has done so much work on this, inflation pays your debt for you. So you don't have to pay the debts yourself. You get to have that liquidated by other parties, which is fantastic. Dan, there's so much inflation all around us. We see the bag of potato chips has fewer chips in it, yet and the price is higher. And there's all of these different categories where inflation is happening, and they try to mislead us to make us think it's not happening. One category that I've been talking about a lot lately is the category of how everything today is self-service. You go into a restaurant, you wait in line, you order your food, you take a number, and then you come back and get your food. And it's like a expensive restaurant, it's not a cheap restaurant like a fast food place. They don't even serve you anymore, yet they still expect a tip. And I thought you were supposed to wait on me if I give you a tip. It's just crazy. And there are just all these examples everywhere of where we're doing everything for ourselves nowadays. All these self-service websites that frustrate us endlessly. I just remember the old days, people used to wait on us, right? Yet back then, things were less expensive too. But that's another way to hide inflation, is you just keep getting less. It keeps costing more.
Yes. What's really interesting as well is I've also done a fair amount of work in terms of looking at things like Social Security and Medicare, and kind of taking a look at how these programs are actually working in practice in terms of the cash flow coming through on an inflation-adjusted basis, and where the holes are in the inflation indexing and so forth. It's interesting because this has brought me in contact with many, many people who are out there living on Social Security. They're living on Medicare, so their payments are Social Security less Medicare, plus private investment income, of course. But when you have someone who's on a fixed income that's being inflation adjusted at the rate the government says the actual rate of inflation is, there's really no fooling them.
Mm-hmm, right.
And something I hear all across the board, virtually every retiree you talk to, I think we went through a 3-year period there where the average person on Social Security who was having Medicare Part B deducted was not getting any increase at all. Virtually no increase whatsoever. And did they not have expenses going up?
Yeah, right.
No, it doesn't matter who you talk to, doesn't matter where they live. They're all seeing their expenses go up every year, even as the amount they have available to live on is not going up.
Yeah, we are having to fight for ourselves much more nowadays than I remember. I mean, look, I've been in business a long time, and I remember that we just didn't have to fight our way to get things before. People, this is a cultural comment too, but the system, I don't even want to say people were more decent. I think they were back then, but the system was more decent. Now the system it's just brutal. And I'm talking about any system. To get service, to get answers, it's kind of mind-boggling, how people don't realize this is a symptom of inflation. It's inflationary. This is part of inflation. We're seeing it. We live with it every day. All these self-service everything. Look at how many different websites you have to engage with, and services you have to use, and subscriptions you have. We totally live in a subscription economy. And I've seen the prices of all those subscriptions increasing dramatically. Software subscriptions. Who says there's no inflation? It's crazy how much more expensive that stuff has become.
And front page headline, the Wall Street Journal this morning, expect the prices of all our basic products to be going up.
Yeah, well, got to invest for that. And Dan, thank you for all your work in this area, because it's been really phenomenal. Give out your website and tell people where they can find your work. And are you doing live events lately, or what's going on with that?
Yes, I am. The website is Daniel Amerman, AMERMAN.com. Yes, the next live event is in the Chicago suburbs the last weekend in April.
Fantastic. Well, Dan Amerman, thank you so much for joining us.
Thank you for having me, Jason.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.